Welcome in, everybody. You will notice only one ugly face here staring at you guys this week. Mr. Jeb is in the desert with his lovely wife and wonderful sons, enjoying spring break. He did tell me he's not golfing. I thought that was weird. If you go to the desert, you got to golf. Took his golf clubs and is not planning on golfing. So hopefully he's watching and enjoying, and maybe he'll pop in or ask us some questions. He'll try to stump the joke man here. We're going to cover a lot of ground tonight, just because the last week or two has been fairly hectic since Liberation Day on April 2nd. So actually 14 days. We're going to go through the data, and you're going to see that, again, we have just covered a ton of ground in that time. Don't know that we have a whole lot of clarity, but we have information. We're watching the data. Data is probably less important right now than what happens with tariffs and all of that fun stuff over this 90-day pause. So what do we have? 80 days or so left, 83 days till everything gets worked out. So hopefully those negotiations go well and the economy can stay on track, and we can see some positive outcomes for you guys. But with that, let's jump into the slides. I'm going to do my best to cover Mr. Jeb's content while he is not here. It's real estate numbery stuff that he follows much more closely than I do, but we'll do our best. Before we jump into that, probably the most important thing that we want to say to all of you is we have the second go around of the Educated Homebuyers Blueprint. It's going to be next Tuesday, so a little bit less than a week. This one we are calling the tax return edition of that. Many people every year use their tax refunds as part of their down payment, all of their down payment if they really over withhold. But we're going to go through how to use that money if you have it coming or not. Anyway, we're in the middle of spring home buying season. So if you are interested in buying a home, you want to buy right, borrow smart, and build wealth over time, we are going to go through our exact three-step process that we use to make it easy, stress-free, and clear for you guys. We have some really cool bonuses. I've been working on a Max Your FICO Fast credit score guide. Everything that I've learned through the last 30 years of maximizing your credit score, all of the little tips and tricks. Even if you go from a 740 to a 780, it's going to have a nice change on your terms, get you lower cost, lower interest rate. If we can get you from a 620 to a 640, going to be much better terms, 660 to 680. So some cool info there. We're going to go through all of that. If you are interested, if you are in the market, jebsmith.net/webinar. You can go out there and register, put in a little bit of information. I think we've got 50 or so people registered. Most of those registrations come in here in the last week. So hopefully you're one of those that signs up here and joins us for next Tuesday's webinar. It is very valuable content. And don't just take my word for it. We have, when we did this in January, Becca was one of the attendees there. She had reached out. We did a consultation. We got her fully pre-approved. She found Stephen, her wonderful realtor, there, and they found the exact right home for her. And literally, this was just this morning. She should be getting her keys this evening to her new home. So Becca, if you're watching, maybe you are now an educated home owner and you are not watching, but if you are watching, congratulations. We appreciate you letting us assist and serve you throughout that process. So I wanted to throw this up here. Just again, we show you guys and we talk about the people that reach out from the show, but just to let you know, I do home loans for a living. We show the map here at the end. We can cover about 20 states. Our company can, so my team can help you in about 20 states. I have about 10 states licensing, but just don't take my word for it. Here's 3 recent 5-star reviews from viewers of the show who reached out and that we were able to help with purchases, refinances. So a couple refinances, a couple purchases there. So yes, that is 4 loans among 3 borrowers, but we would love to help you with that if you are at any point in the purchase or refinance process. So you can do that by going to jebsmith.net/start. But with that, let's jump in here and look at these numbers. So inventory continues to increase. For most of the country, you can see we are still below those 2019 levels. Current inventory, 702,000 homes for sale. It's up 33% over the last year, but approaching what looks like normal. So the weekly inventory change, we had 691,000, so it rose from 691 to 702, about 11,000 1,000 more homes for sale at the end of the week than the beginning of the week. That's up 180,000 homes from this time last year. The all-time inventory bottom in 2022 was at 240,000. So you're closing in on 3x where we were at the bottom in terms of homes to choose from. The inventory peak for 2024 was at 739. So we're getting near that level. Again, we like to give context here. In 2015, there were over 1 million homes for sale on the market. 2015 wasn't a bad year. It wasn't a good year. Just kind of a blah, low single digit appreciation year, but it gives you that context there. For those of you locally here in Jeb's neighborhood, Orange County, Huntington Beach, Orange County was up 2.2% week over week. The Huntington Beach active listings up 0.3% week over week. So definitely some more homes to choose from. We deal with a lot of borrowers throughout Huntington, throughout Orange County. Definitely the well-priced homes, the homes that are well-appointed, very nice, updated, still doing very well, but you definitely have more options, and we're not having the bidding wars where you're having to, give up all of your contingencies and overpay to get a nice home. You can see weekly seller count continues to grow. So where we are in 2025, 76,000 new listings coming to the market this week. And then home sales creep up. 72,000 sales over the last week. So that's a crazy number. 76,000 new listings, 72,000 sales. So should tell me with the net difference would be 4,000 additional listings, but we had close to 11 or 12 there. So if Jeb were here, he could probably walk us through the methodology there that gets us to those figures. Home prices continue to trend up just a tiny bit over the last year. We're probably a month or two from the peak of the year, but definitely getting there as we get to the end of the spring buying season where those homes start closing. Price cuts plateaued for now, still at the highest level that we've seen over the last 7, 8, 10 years, but in the low 35%, low 30% range. So about a third of homes are seeing price cuts. 2/3 of them are selling at or above list price. Wanted to throw this in here. Jeb had the numbers for among the nation's 200 largest housing markets. These 42 have the lowest active inventories. We talk about the areas like Florida, parts of Texas, parts of the Gulf Coast that are having a bunch more inventory than what we had in 2019. These are the areas that have the least. And you're going to see some commonalities here. It goes Pennsylvania, Connecticut, Illinois, New York, Connecticut. So really talking about the Northeast, and some of these are 80% less listings, 70% less listings, even at the bottom there, 62. And this goes all the way down to parts of Virginia, Maryland, Pennsylvania, New York, Maine, where we're seeing 50% less homes available. So remember that all real estate is local. It is very important for you to know your market. If you're in the Northeast, very different than Florida, very different than the West Coast here, and how those markets are operating. So wanted to show this to put that in context here. In California, Lance over at Resi Club did a cool article and infographic this week. Was talking about how we're getting close in California to 2019 inventory levels, may be there by the end of the year, but really it's concentrated in just a few counties. The ones there in that teal color are the 9 counties that have already achieved that level. Others are getting close. Some are nowhere near it. If you look at some of these, like Orange County is still well below 2019 levels. So it just gives you some context that things are normalizing, but not quite back to where we were. Before we jump into the slides that I like to go through every week, definitely want to make sure you guys know we are here to answer your questions. And if there's no questions, which there are none right now, with no Jeb to banter with, we can't talk and go back and forth about anything. So if you have a question about mortgage, about real estate, about tonight's topic, this market shift, possibly in your favor as a buyer, depending on where you are, throw those in the comments section. We will absolutely jump in and go through all of the answers that you want. I thought this was really interesting. Saw this on Twitter, on X, whatever you prefer to call it. This was a poll done this week. Says America would be better off if more Americans worked in manufacturing. Over 80% of Americans said yes, we would be better off if more Americans worked in manufacturing. And then they said, would you be better off if you worked in a factory? And about 25% said so. So most people, although they hear all of the talk, it sounds good in terms of what Trump would like to do. We're going to bring manufacturing jobs back to the U.S. These are Americans telling you they don't necessarily want to work in manufacturing, in a factory. So thought that was interesting and important as we discuss and walk through and think in terms of tariffs and what that means. This just kind of blows my mind here. University of Michigan, we talk about consumer sentiment. Every 2 weeks, we get a look at consumer sentiment. It's reaching really low levels, but apparently it is only among Democrats and independents who think that the economy and the direction of the country is going really wrong. Republicans have definitely downtrended here, but if you look back in November, Republicans suddenly went from viewing a terrible economy to being one that's really good and prospects better. And Democrats went from being very bullish on the economy to being very negative. And independents have kind of been in the middle. Maybe we should look at them as the true arbiter here of what's going on in the economy. It's interesting to me that people are watching the news and that filter. And now we have your flavor of news, whichever flavor you want. You want to look at CNN, you want to look at MSNBC, you want to look at Fox. You can hear what you want to hear that's going to tell you it is awesome or it is awful. So please pick independent sources, get out to Substack. There are good economists doing actual good research on this. Now, that all being said, we are in a time of really great uncertainty. The best. And we had a comment on YouTube this week on the podcast. Someone has said, well, why didn't you guys predict this? Trump has been talking about tariffs for the last 4 years. Well, he's actually been talking about it for 40 years. Yeah, everyone knows he wanted to implement tariffs. No one knew what was coming. So no one predicted what was going to happen because no one knew what he was going to do. And we still don't know to this point. So it's going to play out over time and we're going to see how it impacts things. So let's go through these numbers. Powell had a press conference. Heather is here from Inglewood, and I failed to do what Jeb does every week. Chime in with where you guys are from, where you're watching from. We got almost 70 of you here, and that number's going up as we get going here. But let us know where you're watching from. We'd love to always hear. We get a bunch of you from Texas, from Florida, from the Northeast. Where are you at? What questions do you have on your mind? Throw your questions there in the comments. So Omar, thank you for thanks for the great content. And then Heather, thank you for chiming in from Inglewood. But yeah, let us know where you guys are at, where you're watching at, and what you have questions about. So Powell did a speech today, and then there was a Q&A session, and the Q&A was informative. So this is a direct quote from him. We may find ourselves in the challenging scenario in which our dual mandate goals are in tension. If that were to occur, we would consider how far the economy is from each goal and the potentially different time horizons over which those respective gaps would be anticipated to close. So again, what are those dual mandates? Full employment, price stability, which is defined as 2% inflation. They use core PCE. So when we look at that, what he's saying is right now, it's looking like inflation may begin to increase. And then full employment, we have full employment, but it is trending up. Unemployment is trending up. So let's take a look at those things. He commented that the tariffs are likely to move us further away from our goals, probably for the balance of this year. And generally, I don't think he's saying that means that we're going to have lower unemployment or a spike in unemployment. Really, they're talking about inflation. There's 100% valid concerns about what tariffs do for inflation in the near term. The best data that I've been able to see so far projects that inflation will be in the mid threes over the next 12 months. And we've been safely under 2%, under 3%, approaching the 2% Fed goal and target for probably 3-4 months now. So the last thing he said, Powell gave no indication on where he sees interest rates headed, but he noted that for the time being, we are well positioned to wait for greater clarity before considering any adjustments to our policy stance. So let's consider that. Just 2-3 weeks ago, we were looking at the Fed funds futures projecting that there would be 4 cuts the remainder of the year, with the first starting in June. At this point, he's telling you we are out of the game in May. Likely also going to be out in June, because if we look at that 90-day pause on the tariffs, when was that? On about 4/10 or so. So that puts you out to the middle of July. We're going to have to see some really strong negotiations and real good progress towards most of these tariffs going away or being minimal in terms of their impact. They're going to hold off as long as they can and get more clarity in a very unclear situation. So here's the reads here. Cleveland Fed does their nowcast on inflation. They have yet to see a spike. So 0.23% on core CPI expected for next month, 0.25 for overall CPI. So right at or below that 3% level. For PCE, better than that, both in every measure of how we're looking at it. So we're not seeing anything in their nowcast yet, but really, you probably haven't seen any changes in prices either. The only thing we've seen economically impacting things is this shift or move to a lot of demand getting pulled forward earlier in the year. We had retail sales today. Retail sales was a little bit stronger than expected, mainly led by autos. A lot of people went out and bought automobiles last month because they didn't know what the heck the tariffs were going to look like. When you watch the news and hear that a car might be $9,000 more, many people said, hey, now's the time for me to get ahead of this. Trueflation, this is a really, really volatile number. So we don't focus on it as much as we used to. It is highly correlated to CPI, but very volatile. But we can see the trend is absolutely still down, and we are well under 2%. So the thing that's picking up on the ground right now is 1% below what is being reported. Again, we will see. Time will tell what happens there with the tariffs. Now, talking about unemployment, total unemployed. So this is U6 unemployment. When you hear the unemployment rate, we're talking about U3. U3 is basically the household survey where they call up and they ask, hey, do you have a job? Are you looking for a job? This includes people who've given up looking for a job or who feel like they are underemployed. They would like a better job. So really just wanted to show you here, is it trending up? Yeah, it's trending up, but it is very low relative to what we've seen historically. At the beginning of COVID, for a period of time with temporary layoffs, 22% unemployment. After the great financial crisis, it peaked up around 17% unemployment. Going back to the tech wreck in the early 2000s and that brief recession, 10% unemployment. We're just over 4% right now. We could go to 4.5%, we go to 5%, we go to 5.5%. And some are projecting and expecting that in the next 12 months. And it's still going to be a fairly strong labor market. This one I threw in again, another one I saw on X, and I don't know. I need to dig into this and see how the Federal Reserve pulls this. This is the share of mortgage refinances that are rejected. So when we look at this over their most recent quarterly reading here, 37% of refinances were rejected. To me, that's a crazy number because I have not seen any uptick in rejections. But again, I think in terms of a rejection is when I submit a loan to underwriting and they come back and go, no, we can't do this loan. I know the guidelines. I know the guidelines as well or better than our underwriters. So it's never going to get there. So does it get rejected? It does get rejected. If you call me up and tell me you got a 500 credit score and you're out of work, we're going to tell you, hey, unfortunately, we can't do a refinance for you. So anyway, you cut it going through 2021, 22, we had the vast majority of them being approved. And now you're seeing rejections increase. I'll try and get some more information. We'll try and watch this and track it over time to see what it tells us. So with all of that fun, happy business going on, what did we see? This green arrow to the left wanted to show you guys. That was Liberation Day, April 2nd. And the initial knee-jerk reaction over the next couple of days is that we were down 15 basis points, or a little bit better than 0.125, about 0.15% better on the 10-year, which translates pretty directly to mortgage interest rates. And then the markets looked at this and said, hey, there's more to this. We don't like it. These are much, much bigger threats and tariffs than what we were expecting. And in a matter of, I think we had 3 days, we're up 50 basis points. But if you actually count, this chart here doesn't show you the intraday lows. The intraday lows were down 20 basis points lower than this. So if we include that, we're up 70 basis points. That's the most variance in a week in terms of treasury yields that we've seen since like 1981. So going back 40, 45 years. And thankfully, this week, no one was really predicting this just because of the volatility, the uncertainty. No one's making many strong predictions, but we're back down about 22 basis points or 0.25%. So bottom line, we dropped an eighth, we went up 0.5%, and we're back down 0.25%. Kind of back to where we were started, but actually just a little bit above that. This is the same chart we look at. I have those down channels out of here, but wanted to show you this sideways trend. A couple different ways of looking at this. So that sideways movement, if we take the 3 days out when we had Liberation Day reaction there, and then 4 or 5 days there with this knee jerk that threw us out of the top of the range, we are back in this sideways range about where we've been. So means rates 6.37 or 6 3/4, 6.875, somewhere in that range. But this again just shows you, this is the chart from Mortgage News Daily, the rates. We had a couple days of decrease in rates, a solid week of them spiking up, and then coming back down, and we're just slightly elevated from there. These another way of looking at those ranges, it just tells you where we're at. We are dead in the middle of these ranges. I watched a very, very good webinar with a technical analyst yesterday. So she doesn't look at fundamentals at all. She is solely digging in to the technicals and what the charts are saying. Unfortunately, her feeling is that 10-year treasury yields are going to be back over 5% within the next 1 to 2 years. But she said the range that we're in right now, it's about 4.75, which is a little bit higher than we got last week, all the way down to as low as 3.6. So expecting that we would likely see another run down. So what I would like to say with that, we're going to show a link here to our rate watch that you guys can sign up for. With the rate watch, we actually have a couple borrowers that have just said, you know what? I know the numbers aren't there right now. I'm going to send you everything. We're going to do the application. We're going to send all your documentation. And if it comes in 2 weeks, 2 months, 2 years, we're going to be in a position to take advantage. And what they're saying is we had a window, basically one morning, where we would have been able to get people the best rates where yields were under 4% on that 10-year. We didn't capture all of that into our rate sheet, but we could have got the best rates of all. But you have to have your application in. So join that rate watch. We'll reach out to you. We'll give you that opportunity. What are we looking at in terms of interest rates? Again, here, safely back under 7%, about 6 7/8, 6.875 for most people. Well-qualified borrowers, big down payments, 800 credit scores, probably a little lower. FHA and VA in the low sixes, again, with 0 points. And well-qualified borrowers, we can do a little bit better than that for you. So this is the link to the rate watch. If you have a rate that's higher than what you want, go ahead, click that link, go over there. We'll ask you a couple questions so we know what you have. We'll ask you to upload your current mortgage statement. Funny thing is, we've had a couple people that redact things on their mortgage statement, or they want to just send a little snip. No one can do anything with your mortgage statement other than pay off your mortgage for you. So what it allows us to do, it gives us the property address, gives us the loan type, tells us how much you owe, and we can run better numbers for you and track it better for you. But that's really all it's going to ask for, some contact information and the current mortgage statement. So if you're interested, join that there. Again, if you're interested in getting pre-qualified, pre-approved, talked to about 3 people in the last week that got an offer accepted and then got cold feet with the lender that they're working with. And it is not uncommon. We usually, in every given week, get 1 or 2 calls from people. Hey, this person, I don't know if they have my best interest at heart. They're not answering my questions. They're not getting my disclosures out. They're not making sense when they make these explanations. If you want to be one of these 5-star reviews, go to jebsmith.net/start. You'll get connected to me in the majority of the country. It's about 85% of leads come to places where we can help you. About 15%, we will refer you to a trusted team member that we feel will treat you just like us. This map actually shows you, and I got to get the updated map in here because we have a couple of additional states in here. So the red states there are the ones where we can cover and assist you. The blue states are where we will get you connected. But Alabama is now red for us. Connecticut is red. There's another one in here. I want to say it's Wisconsin, but not 100% sure. So if you're interested, let us know. We would love to help. So let's look at this and let's go and figure out where in the heck you guys are at. So we already talked about Heather's here every week from Inglewood, Melissa Robinson in Maryland, Crowd Control in the Bay Area, Desiree Dorset in Las Vegas, miscellaneous of the whatever here every week. I didn't know you were in Vegas. Maybe we did. Maybe you told us before and I forgot. Omar Effects, Boulder, Colorado. I like that. We got Corbin in Dayton. We got R. Baker in New Jersey, SR in Atlanta. We're covering all our bases tonight. Maria Annette in Florida. We got Michigan, Savannah, Georgia with G Money. We got Washington State, my adopted homeland. My wife is from Olympia. For those of you that didn't know, I went to school at Eastern Washington. Go Eagles. Mockingjay gives us MS. MS is Mississippi, right? I hope so. Hope I got it right. And then we got another Bay Area with Michael Frazier. And James Gray is going to break the seal for us tonight with a question. With today's interest rate market, would you build an addition to a house or buy a larger home? I'm concerned about losing my 3% mortgage and realtor fees if we sell, but also construction costs. Those are really good questions. Very valid, very reasonable concerns that you would have. Jeb, and I would probably answer this differently. He went through this process and decided to sell his home with a 3% interest rate and bought a home with almost a 7.5% rate. He's refinanced a couple times. I think he's down close to 6. But The answer is really the numbers never lie. I would say pencil it out. And when I say pencil it, I don't mean guess. Talk to a contractor, see what that addition sounds like, and probably start with how much do you like your house? I love my home. When we moved there, I didn't expect to be there forever. We've been there for 22 years. My neighborhood's great. If I needed more room, I could absolutely see building on to our current home. But talk to a contractor, get some good, solid numbers on what that's going to look like. Find out what a second mortgage is going to cost you, or if you have cash to pay for it, great, even better. But it's a pretty big difference. If you like your home and like where you're at and feel like you could add to it in a beneficial way that would be supported, and talk to your realtor, talk to your agent that helped you get into that home and say, hey, we're looking at adding 600 square feet. This is what it would be. It would be adding a second story. It would be adding a master bedroom off of the back of the house, whatever that may be. Go through it with your realtor, have them comp it out, have them show you what that would look like when you are done. Look at this. We got splits perspectives from Tacoma, ZL, and El Paso. We got in Arizona. We got Oregon. We got Omar in the Tri-Cities. You got to like the Tri-Cities. I didn't even know what the Tri-Cities were until I moved to Washington. All right, another question here. Corbin says, in your opinion, would you buy before a Fed cut? Asking because I know the previous cut rates went up by almost 1%. I give zero thought to planning for myself or for my clients in terms of what the Fed will or won't do. The Fed, again, they have their dual mandate. Full employment, which generally decreasing interest rates will help full employment, and then on the flip side, they want price stability, so inflation at or below 2% in terms of core PCE. So with that involves raising interest rates. So going forward, what comes next? Take it with a grain of salt. I am biased. I've been in the mortgage business a long time, 30 years. 30 of those 30 of those years coincided with a 40-year bull run in interest rates. I believe that the underlying factors, not the government buying, not the government stimulus that pushed rates to those ultra low levels, but the things that led to low rates are still there. They haven't gone away. Are there some competing elements there that are possibly pulling us in another direction? Do we absolutely have to figure out the U.S. government debt? Yes. But when I'm looking at this, I don't really care what the Fed is going to do. I look at what I think interest rates are going to do. And we have had a much stronger stance, Jeb and I, that we share here every week in terms of what we think is coming next. Like right now, for the next 90 days, I don't have a thought or an opinion. Spoke to a listener from Arizona earlier today. She got her property accepted on Monday. She's working with a lender out there. One of the ones not getting answers that she's super happy with or feels like she's up to speed. And he said, hey, don't worry about it. I'm going to watch interest rates. I'll let you know if we need to lock. And I said, that's bullshit. That is bullshit. No, no one watches it closer than Jeb and I do. No one has better sources than we do. Maybe as good. Maybe they watch it as close. And I have no idea. I was shocked by the rate of increase last week. I am pleasantly surprised by the dip in rates this week. No one could have predicted it. If you have a close in the next 30 days, you have to decide your risk tolerance. That viewer said, hey, I'm buying way less than I can afford. So if it goes up an eighth, it's not going to kill me. I'm going to be okay. So with that, she probably does have some risk tolerance where she doesn't necessarily have to lock. But if you're the borrower that if rates go up an eighth of a percent, you no longer qualify, or now you're having to pay a half of a point to buy that rate down, you need to consider very strongly where you're at. So that went above and beyond your question of would you buy before a Fed cut? I don't give a rip what the Fed is going to do. I look forward and think, what do I think is going to happen in the economy? And right now, if I were deciding to buy, I would say, am I comfortable if I have this rate for the next 30 years? Just because we know we get a 30-year fixed rate, it can't get worse, but we don't know that it's going to get better, and we don't know that it's not going to get worse if you wait. So know what your alternatives are. Are you renting right now, and are you comfortable continuing being a renter for the foreseeable future? Do you own and you're looking to sell and buy something else? Are you comfortable staying in that home for a period of time? You got to know your situation, but hopefully that's an answer that helps you. We got slow motion. I wanted to say slow motion for me, but it's slow motion for me. I get it. I'm a little slow on the uptake myself. What is a good rule of thumb for a home purchase price? 3 times annual income, 4 times annual income? I wouldn't look at it that way at all. Just because what matters, especially relative to your income, is your monthly payment. So what multiple of your income are you willing to put towards the payments? Now, again, that's a moving target. The price of the home is fixed. So we would much rather run this calculation off something fixed like the price you're going to pay for the home. But the reality is we have to go, how much of my income is going to go to this, which again, the beauty of a 30-year fixed rate is that you have a ceiling on what you would have to pay in terms of interest. And you have the option at any time to pay that thing off and get a lower rate. So from that perspective, I would focus more on debt to income. And an interesting way that this gets asked all the time, borrowers ask me, they say, what do you think I can afford? I have no idea what you can afford. Some people want to eat out every night of the week, expensive meals. Some people go out and party every weekend. We have some friends that would go out and have $1,500 of drinks on the weekend. And like, that's absolutely insanity. They would do it every weekend, come $4,000 or $5,000. You can make a lot of money, but if you're burning $4,000 or $5,000 a month on drinks and hanging out with your friends, you can't qualify for them, or you can't afford much. But if I look at it, I don't know where your money's going. I'm just looking at, well, they got an auto payment, they've got this and a credit card, they got everything under control. So from that perspective, know yourself, know what your comfort level is. From the craziest stuff, the advice that Dave Ramsey gives, do a 15-year mortgage with 20% down with no more than 25% of your net income. It's about as conservative as it gets, to we talk about here on the show. An FHA loan will let you go to a 57% total debt to income ratio. That also is aggressive. But I will say most of the people, we don't do a lot of those, but when we do them, most of those folks, there's something going on there. There's under the table money. There's something that makes them comfortable going to that debt to income ratio. But know yourself, know your situation and what makes sense for you. All right, guys, you're letting me down here. Mr. Jeb doesn't show up, and we've only had 3 questions, and I got nothing in here. So if you're watching, you got a question about buying a home, you got a question about real estate, selling a home, mechanics, any of that stuff, let us know. G Money here with a question, just refinance at 6.6%. Would have been lower, but appraisal was low because there were no houses available for an accurate comparison. Is that a common problem? Depends on where you're at. For us here in Orange County, we're densely packed, tract homes on 6,000 square foot lots. There's lots of homes, even in the lower sales activity environment, there's lots of homes for sale. Now, if you go out to an area that's more rural and there's a house every mile, it can be difficult. It can be very difficult to find comparable sales. So it just comes down to where you're at, how dense the population is, how many homes you have. If you have a very unique home, I had one, we got lucky this week, that a tract home here in Orange County, but it had an ADU. There are not a lot of those around. I was worried of what that value was going to be in just because the lack of comps. And fortunately, there were a couple of good ones that recently sold and got us a very, very good value from that perspective. So know your property, depending on how unique your property is, depending on how undensely populated your area is, it can absolutely be an issue. And hopefully your lender can go through that with you up front. I'm not saying that we don't ever have appraisal issues, but one of the things that we like to do, we like to pull an AVM up front, and it will give us the comps, everything that's sold in your recent area, and we can tighten that up. We can tighten it by square footage. We can tighten it up by distance, by time, and get a pretty solid idea of if there are comps out there to support what you think the value is. You guys will be shocked to know that nearly every homeowner thinks their home is quite possibly the greatest home that has ever been placed within 5 miles of their home, and will appraise for the absolute top value. Rarely the case. There's usually someone in your neighborhood has a nicer home. So we always need to make sure, are the comps there, and are those comps going to adjust out both in terms of quality of how nice that home is, but size, quantity, all of that stuff, lot size, pool, amenities, all of those things. So hopefully that helped, G Money. Split perspectives, back with a really good question here. Bought a single family home on a multifamily lot. I confirmed with the city that I can convert the single family home into a duplex. Problem, there are tenants until October. Would you just wait to do this conversion? Okay. So it's a single family that you have as a rental. I was assuming that you were living in this. We have and then follows up here with a follow-up question, or what other options are there in this case? I don't think there's anything preventing you from doing construction while they're there. I don't know that they would love this idea. You probably want to talk to a real estate attorney that says, what can you do while they're in the property? And then you have to judge what's appropriate, the golden rule. What would I like to have done to me? Would I be comfortable renting and paying a certain amount of rent and then having construction going on? From your perspective, the big picture, this is awesome. If it can literally be considered a duplex, we have a listener to the show that during COVID refinanced 10 different properties, and the majority of them he had bought in between 2012 2013 down in the San Diego area when the market was absolutely in the dumps. And he bought a bunch of duplexes that were on R4 lots or R2 to 4 where he could put additional. So he was telling me, hey, I'm adding ADUs, but when we look at it, it wasn't ADUs. They were actually now 4 units. So these properties he picked up for 250, he put another 250 into them in building the units. They're 4 units. They're all like $1.5 million, $1.6 million properties now 15 years later. So that's your best case scenario. Obviously, your mileage may vary based off of construction costs. So know what the property will rent for, know what your options are, and just make sure you're maximizing in terms of what you can build. But can you do it? When should you do it? Really, from that perspective, it just comes down to there's the legal aspect of it and then what you feel right doing with those tenants. Ooh, this one, ZL. I wish Jeb was here because he probably has some better questions. What straight to the point question should you ask to determine what agent to go with? I would ask them how many transactions they have closed in the last 12 months and the last 24 months. And that's not to say, hey, it's got to be a massive number. And I would want to know their numbers personally. A lot of times, the biggest agent in your area may be the rainmaker, and they have 5 buyer's agents. And that buyer's agent will say, well, we've sold 72 homes in the last 24 months. Well, he's been on the team for about 6 weeks and he hasn't closed any. She hasn't closed any, whatever the case may be. So I want to know that you personally, as the primary rainmaker, brought it in, transacted, closed that, negotiated, handled everything from A to Z. That to me. And then again, point blank question is, why should I choose to work with you over any other agent? There's no lack of agents. There's no lack of mortgage professionals. If you ask me that question and I fumble and stumble and don't have a very direct answer, you need to just move on. Like if the person, especially as a realtor, we don't really negotiate for you on the mortgage side. I shop for you. I shop all of our investors. I guess I negotiate with underwriters when we're trying to make sure they clear conditions or don't insist on things that we shouldn't need to provide. But your realtor is truly a negotiator. There are other elements to the job, but what I can say when I listen to Jeb on the phone, when I see how he advises his clients, when he helps his clients, the number one thing that I would say is most valuable is the negotiation skills. So if you're able to win the negotiation with your agent and they would come down from, I want 3.5% to represent you, and they walk out the door taking 1%, that's probably a really good sign that they shouldn't be the person that you choose to work with. So those would be my big ones. Ask them why you? Why should I work with you? What's different? What's better? And how is that going to benefit me and my family? Because what you'll find is many will stumble and fumble and not be able to answer it. Many will give you reasons that could be great reasons, but don't matter to you. So if someone says, hey, my value is I'm awesome at A, B, and C, and you go, well, I don't care. I value D, E, and F, I would move on. So I would make sure it's someone that's active in the market, doing transactions, and can justify their value proposition to you. So hopefully that was helpful. Omar, what type of loan does it require to build a home on a paid off property lot? It's a construction loan still, but the benefit with that is that when they're doing the loan to value calculation, your equity in the lot is going to count for you. So it's not like you're going to have to make a down payment for that construction loan. So hopefully the lot has value. Some parts of the country, lots can be incredibly valued. Jeb sold one in my neighborhood probably 5 years ago now for like $800,000 where a home had burnt down. That lot today, if it were to sell, would be a $1.2 million lot. The lots are more valuable than the property that goes on them. But some parts of the country, that's not the case. You can be out in Arizona in the desert and get a lot for $5,000, and what you put on it would be the value. So it's still going to be a construction loan. You got a lot of options in terms of construction loans. If you have questions, we've got the webinar banner there running at the bottom. But for any of you that have questions, want to get connected, use that link at the bottom, jebsmith.net/start. that will get you connected to me in most parts of the country, and we can go through those numbers and let you know what those options look like. So, Steve, this would be a better question for Jeb. As a landlord and an owner, I should know this, but I don't sell. I only buy real estate. Just got a multifamily under contract. Do the tenant's deposit transfer with the sale? It is listed in the contract, and yes, they should. The deposit is not obviously not the property of the owner. It is held in trust for the tenant, so that does need to transfer over to you at time of closing. But I believe that's all spelled out and written in the contract, depending on where you are in the country. So split perspectives, back with a little follow-up. Yeah, there's an ADU in the back, which is where I will be living. Did not have enough space to type all this, but thank you. Okay, cool. Glad that was valuable for you. So Sir Williams follows up with, how far do they go back when checking what sold in your area when you get your home appraised? 6 months, 1 year? They can, but the further they go back, the more likely it is that they'll have to make time adjustments. They are preferring to see homes that have sold in the last 6 months. And what they're also going to do, if there was a home that sold 3 months ago in your neighborhood for $300,000, they're not going to go back and look at the one that sold 6 months or a year ago at $500,000. They're looking for that trend, and that's why we have multiple comps. We have 3 primary comps and generally 3 additional comps that are listed in there. They need to bracket on the high and the low side. They need to show the trend, and the market conditions addendum in there has to show the trend for your neighborhood, so that the underwriter knows that you're not just cherry picking your comps and saying, oh, I'm ignoring these over here and I'm taking these. And there are like basically AI tools that all lenders use now. They're going to run that through. It's going to give them a quality score. Hey, are we comfortable with this? Is this pretty straightforward? It's going to throw up any red flags and say, hey, it looks like there were 2 other comps that were much lower that were ignored. And your appraiser may have to comment as to why they overlooked those. Mina, back with the super chat as always. You're too kind with these. Jeb and I are going to retire early off of the super chats. Recently added a deck to my townhouse. Is this automatically reported to the county to add value to my property, or do I have to report? It generally, if you have permits, they are going to know what was done with permits. A lot of times someone will say, hey, we added a master suite onto our house, and you go and look at that and you're like, I don't know. I don't see the square footage here. Oh yeah, we didn't pull permits. So the key there is, if it's permitted, it should be known to the city and listed there. You can ask your realtor, but I think you bought new construction, so you may or may not have had a realtor, but just ask and see how it goes in your area. T-Tom19 says, thoughts on the potential of the burned out lots in Altadena. For me, it has always been a hope or a dream to build a home. Yet I live in an area where there are very few lots, and the ones that exist are either weird or incredibly expensive. So with this, I've looked at those areas and said, that would be, if I lived in those areas or wanted to live in those areas, it'd be awesome to acquire one of these lots and build the home exactly the way you want to. So I certainly wouldn't shy away from it. The big questions that I would have would just be, what's the fire insurance going to look like in those areas? Altadena was a little bit unique. It doesn't appear to have been as high risk of a fire area as the Palisades, but if you're going into the Palisades, it's going to have some really, really high insurance costs. And obviously, in terms of the building, you're going to have to build back something much more fire resistant than what the old codes were. But for me, I wouldn't shy away from it. I would actually think it was a bonus or something cool where I could go in and build what I want to build, if you can do it on a budget, obviously. And the interesting piece about that, what will play out over time, is what is going to be built there, is it going to be consistent? We generally had builders would go in and build tracts of homes, so they were all similar size, similar amenities, similar qualities. It'll be very interesting if someone wants to go and put a McMansion in there, and the next door someone wants to put, a very basic no frills home. It will be interesting, and you won't know that until a little bit of time. So MF with a very good question. With recent volatility in the bond market, is there any change in availability of non-QM loans? In availability, no. I have not seen anything come across changing guidelines. I had a loan in process. It was a non-QM second for the borrower with the ADU. And we could not, well, on that program, you cannot lock until the loan is approved. So we're waiting for the approval. Everything jumps off last week. I'm like, dude, I got to get this thing locked. We didn't get the approval in time. And it was about 2 points worse in price, which is way more than the market had moved. So we saw a lot of the non-QM investors last week. They did not know what type of liquidity was going to be in the markets for those types of loans. So they just stepped on the pricing really bad. Cool. If you want this and you want to pay that, I'm comfortable there's a market for it. But as of today, that loan is back to the same as it was priced prior to the hiccup there, last week. So fairly quickly recovered. I wouldn't say that's across the board, but I would say most lenders priced worse and are back to pretty similar to where we were. So Danielle says, hi, Josh. Good to see you. Well, very good to see you too, Danielle. Thank you for saying hi. Got a couple more good questions here. ZL says, what's stopping big investors from selling a property under market value to themselves or family or friends to tank market comps so they get other properties at more favorable prices? You would have to have a ton of money to set the market yourself, like the Dukes from Trading Places, not the Dukes of Hazzard, the Dukes from Trading Places. So you have to have a ton of money, but most importantly, those aren't market sales. So I guess the best way to look at it is here. I had 2 properties in Anaheim that I bought, I think 2015, actually bought 2 of them from Jeb. So we bought one, and then like a mile away, less than a mile away, we bought 2 from Jeb. And we bought them all off market. None of them hit the MLS. So the assessor here in California, they look at that and they say, that's not a market sale. So we're not even going to use that in determining the value. You have to go and show the market sales. So what we had to do is give them the pictures to show how awful all 3 of these properties were, why the off-market price was the market value price, and we got pretty close to what we paid for them. So not directly comparable to what you're asking here, but if it's not a market sale, if it's not an arm's length transaction selling to someone that you have a relationship with, that's not treated as a sale. It's not indicative of what the market is. Lenders are looking at on an open sale, on the open market, if someone lists a home for sale, what does it sell for? Paul, this is a great question, and one to which there is no answer today. Should I lock in interest now for my new build or wait it out till August when it's time to close? I would talk to your lender and find out what the terms are, because we're 4 months out. 120-day lock is generally pretty expensive. Builders lenders can offer a little bit better terms on those long-term locks, and they oftentimes can provide better terms on float downs or a free float down, within 30 days of closing. If you have a float down option, it wouldn't be bad at all to just step aside from all of this volatility. We saw last week it's not even the worst case. It could have got worse. If Trump had not reversed course, we would be looking at much worse rates today. So we saw what could happen with rates. We don't think it's going to happen. We don't think they're going to push us over the brink. They're just trying to get up close to it to negotiate art of the deal style. But that's what your total risk is, and it's not based on anything that's predictable. So from that perspective, know what your tolerance for volatility is and err on the side of caution in the current market, just because it's a little bit bonkers out there right now. Smart Fox says, shopping for home insurance, what should I look for? Currently, I'm with State Farm looking if I can do better. Should I go for a smaller insurance company? Not a super area of expertise for me, as witnessed by the fact that I'm not even going to know the term, but there are out-of-state small carriers that don't, it's like a qualified carrier. There's like a word for it. You would be better off to not go with one of those carriers. You want to make sure it's a big carrier, that if there's a loss, that they're going to cover it, that they're going to have the financial stability. So if I were to go with an insurer that I didn't know or had never heard of, I would want to get super clear on how they have a comfort level, and I can have a comfort level that they're going to be able to cover me in terms of a loss. In general, from a high price insurer to a low price insurer, for most, not high end properties, we're talking $200, $300, $400 a year, which is real money. But I don't want to risk that over $30 a month savings, if that makes any sense. So Wilson follows up, hey, it's a good question. I'm set to close in 4 weeks, got a referral from my loan officer, and I'm also getting quotes from USAA. In the current market, I think you would absolutely do well to get multiple quotes, and not just shop the price, but shop the price and shop for a reputable insurance company that you're comfortable with, that you know of, that is big. Jennifer has a question here, and I know there's an answer to this. I do not have that answer. Is there a place that lists homes that are for sale with an assumable loan? There is. I don't know that it's comprehensive, but here, let's go over to Josh GPT. Actually, let's go to GPT Deep Research. It may take a little bit of time, but is there a website for home listings with assumable loans? I will let you know here in a minute. I know there is. Let's see if it can find it. Um, so Eric pops up. So Jennifer, I'll circle back if I get a good answer here. Um, Eric says, haven't caught live in a while. Missed y'all. So you're going to miss Jeb tonight still because he's not here for you. My question is, how will tariffs affect new home build prices? Do you see more incentives coming from the spec builders as a result? There's multiple tiers there. The first thing that people think is what's tariffs going to do to materials prices and the homes. So from that perspective, my understanding is that less than 9% of the materials that go into a new build are imported and would be impacted by the tariffs. That's a guess, an educated guess from obviously someone doing the research. And the National Association of Home Builders forecast about $10,000 additional cost. So if you're in a soft market, they're going to have to absorb it. They can absorb it in additional concessions. They can absorb it in not going up in the home price. We've talked about this a bunch of times on the show, and it really comes down to supply and demand in the area. The areas where there's a lot of demand. So Vegas is still hot for new homes. They're making very small concessions out there. You go down into Florida, they're making much larger concessions. And almost all of these builders, the big national builders, are public, and you can read the transcripts from their quarterly calls. They're pretty straightforward and honest about this. The numbers are out there. So if it led to higher interest rates, it's going to be more problematic. They're kind of at the high end of what they can tolerate in terms of interest rates because they can buy them down to areas, to rates that are more tolerable for folks. If we get much higher, I don't know. It would not be good for the builders, but again, it falls into that giant black cloud of uncertainty that we have for the foreseeable future until this all gets negotiated out. So Jennifer says, we're just thinking maybe I could find a home for sale that offer that type of loan with a 2% rate. I could possibly take over. The important thing to remember here, most of our viewers here are looking at putting 3% down, 5% down, maybe 10% down. So if that's the case, most people with 2% interest rates are sitting on 30, 40, 50% appreciation. So you have to be able to bridge that gap. Yeah, you can look at secondary financing. If it's a VA loan and you're not a veteran, the seller veteran has to be okay with keeping their entitlement tied up in that property for one. And then the second piece of it is that you would have to bridge the gap. And that second, the VA requires the second, if you're going to bridge a gap with a second mortgage, to also be assumable, which most seconds are going to be max 95 combined loan to value, more likely 90, and they're going to be at a high interest rate. So would the blended interest rate still make sense with the 2% first? Heck yeah, it absolutely would. But the majority of the assumable deals that I'm seeing come together are people who have a big down payment, people who sold a home and came out of it, and were able to look at that. So, Joyce, what do you think of today's announcement from Jerome Powell on economic consequences from tariffs? We did already discuss this, Joyce. Go back to the top of the show. We actually had some of the quotes there and went through it and actually followed up with some data. Real player, first-time buyer here. I got a quote, but I'm having trouble knowing how my lender is going to talk to Allstate about the coverage. Will a lender delay contacting the agent? This is the last of your concern. The thing that I do not want to have be a problem is the homeowner's insurance. So I want you to get your quote real quick. I want you to send it over to me. We are going to send the loan number, the mortgagee clause, and let them know exactly what we need so that we can get it in and get it in front of the underwriter quickly. So you're saying you got a quote, but you're having trouble knowing how your lender is going to talk to. If you have worries about your lender, if they haven't built this level of trust with you that they know how to manage the transaction, use the link below. Again, I am shocked at the calls that I get every week of the silly bullshit that you guys are having to deal with. So what everyone hears, they do hear the message, hey, we're doing what you guys told us to do, shop multiple lenders. Shopping does not mean shopping for a rock bottom low interest rate. Most of you, if you needed to get something that you're going to have for the next 15, 20, 30 years in your life, you wouldn't go out to Walmart and see what's the cheapest version you could get. You would want the best value that's going to give you dependability that's going to work for you over time. But for some reason, people get hung up on, I want to get the lowest interest rate out there. You want competitive terms, but you want an expert that is going to answer your questions accurately, honestly, quickly, that is available, that's going to manage this process and front load it so the stress is off you as soon as possible. And that includes tracking after the insurance. So again, if you're looking for that, need that, use that link below, jebsmith.net/start. About 85% of the country will be covered and come back to me. And we would love to talk you through that earlier rather than later when you're feeling stress. So it looks like we don't have a whole lot of questions. We're coming up on 55 minutes. Would love to answer any and all questions you have. So throw them in here if you have questions. I don't have anywhere to go for the next 15, 20 minutes. So if we have questions, I'm more than happy to stay. If not, we will wrap it up. This is probably a good spot again to kick it over. I'm going to switch the banner here at the bottom. And just another reminder here, the Educated Homebuyer's Blueprint for Buying. If you have questions, you want to look at that 3-step roadmap for stress-free home buying to successfully navigating this market. So like Becca, you can be a homeowner in 30, 60, 90 days. Join us. I'm biased. We did a really good webinar in January, but we got some really good feedback from the folks there. So we have some tweaks, some improvements, and we have some much better bonuses to give out. So that is next Tuesday. I think Jeb had it up there, but it's either 5 or 5:30 Pacific. So it should be enough time for you to get home and join us. So if we can help you with that, definitely make sure to register. We would love to see you there. I think we did have another question. So Wilson says, I agree. I was applying with 2 lenders. I went with the person who made themselves available, calls me as soon as he has a question and answers when I call with the question. A couple things there that I think are really important. We're going to have questions. So it's good. It's good that they're reaching out quickly because you would be shocked at the procrastination. Our company has 150 loan officers. This is a true 80-20 industry. We've got 20, 25 pros, 5 or 10 at the most amazing loan officers, and many, many people who cause themselves and their clients problem after problem by not being proactive. So that's big. So a lot of times I hear people, well, my lender's calling, he's asking this question, he's asking that question. Hopefully they're able to ask you that question and pose it to you without you feeling like there's a problem. Generally not a problem. We just need clarity. We need clarification. We need to dial everything in for you. But answering when you call with a question, that is important. I am on the phone almost all the day. Maybe 50% of the time can I pick up, but generally within an hour, I'm going to be back to you and we're going to go through that. You deserve that. Without that level of communication, this can be a very stressful process and you want it to be a stress-free process. Daniel says, buying a new home with a buy down loan a good option right now. $30K incentive and 5% at the 3rd year, 4.99 at the 3rd year. There's not really any downside. So if I'm reading this correct, Daniel, it's going 299, 399, then to 499. So I don't know. For me, I would rather if you could get a 4.5 permanent rate and not have the cost of that buy down and maybe get a lower price on the home with a little bit less of an incentive. The builder probably doesn't want to do the lower price on the home. They're trying to prop up the value, so they want to give you these incentives to make that work. But it certainly doesn't sound bad, right? 499 on the long haul. So it's probably an FHA loan. What we can say is if an opportunity comes along and rates plummet in the next year or so, then you're going to be able to take whatever is left of that buy down and apply it to the loan balance and reduce what is owed. So don't really see any downside to it. And a lot of you guys are making that decision right now that maybe I don't want a new construction home, but the numbers are so much better that affordability wise, it makes all sorts of sense. So hopefully that was helpful, Daniel. Split Perspective says, so I did just obtain the property, but are there loan options to get that construction funded and not need to come out of pocket all the way for certain things? Yes, there are. So the fact that you're living in the ADU, it's much easier to do it owner occupied. So FHA has a 203K. You can do that. Fannie has their home style renovation loan, and I forget what Freddie calls it, but they're pretty darn similar in those regards. And Fannie Freddie, I believe they do have a non-owner option for that, but you need more equity in the property for the non-owner options. So those would be the big things, but definitely have financing options for them. Just they're going to lend to you off the after repaired value. So we're going to say, okay, when it's appraised, here's what it's worth today, but they're also going to say, here's what it's worth as a duplex with an ADU once it's all done. So definitely want to talk to a lender. If you want to talk to us, use that link, reach out. We'll be happy to go through it with you. We are coming up here on an hour. I will throw this out here before we go. Again, there's the map of everywhere we can help you guys. Here is the link, jebsmith.net/start, if we can be of help. And then, hold on, got to get all the way back here to the beginning. There's the webinar and the link, all of that of what we're going to be doing next Tuesday. We would love to see you there if you're in the market, and don't feel like you have to be buying now. Never too early to educate yourself and know what you want and need to know for the market. So if you're buying next year, you want to buy later this year, never too early to start that process. So definitely register for it and join us. Ooh, real player, you have a good question here. I'm going to answer this on the way out, unless someone else pops up with a really good question, but I like this one. If my lender botches this, is my contract null and void? I think the lender is good. Have a good one. No, your lender screwing up your loan doesn't make your contract null and void. It can make you out of contract. It can make for a very stressful situation of trying to get inside of the terms of that contract. If you're out of contract, then the seller could potentially have an out that could mean you're out of a contract, but it doesn't just by definition mean that you're kicked out. If you have a good lender, you shouldn't have to worry about it. But yeah, that's what we got. So again, we're just about an hour in. I don't see any questions. So appreciate you guys all for showing up and listening to one guy talk for an hour without my cohort here. We will both be back next week. We'll give a breakdown of what the webinar looks like. If we can help, jebsmith.net/start, get you connected with me to figure out what your loan options are, get your questions answered. If we can help educate and empower you, show up to the webinar next week on Tuesday. We would love to see you there. If we don't see you there, we'll see you back here on Wednesday. All right. Have a great night, everybody.